Welcome. Welcome again, my friends, my people, whoever decided to watch my video one more time. Thank you very much. I appreciate you. So, today is my birthday. Instead of you giving me a gift, I made a gift for you. This might be a very interesting gift, and I appreciate you to receive it. Please take a chair, sit down, and watch. So, what happened to Russia when the US decided to put sanction to Russia economy? What happened to North Korea when the US and the whole world put sanctions on North Korean economy? What happened to India, Iran, and every other countries that decided to do business with India, with Iran, when US put sanctions on Iran economy? In another word, how they still making these transactions, how they still trade between themselves. What happened to Hamas in Palestine, Hezbollah, and all other these organization when the whole world put sanctions on them in terms of money transactions? Now, because I support Hamas and Hezbollah on all these organizations, but it's just a case study for everybody, all of us. What happened to them? How they still make these transactions? That's the point of my video today, and that's my gift for you. All they do is what? They hide transactions. Instead of using US dollars, Europe, or any other currency that is generally used, that is easily tracked, they use cryptocurrency to transfer the millions, billions of money from Russia to India to China, from Hamas to all these people who support them. Don't make a mistake. Hamas, Hezbollah, and all these organizations, they cannot live. They will not stay around at this time if they don't get support. They don't get financial support. They get support from big companies. We don't know who are these companies, but I can assure you 100% they still operate because they get support. So they get money. How? They hide transactions. They use cryptocurrencies. Everyone knows this. I'm not creating anything now. Everybody knows this. That's how they make this transaction. And that's how crypto was denied to be used officially in the US, in Europe, with these banks and big organizations. They was accused Bitcoin to be used by bad people, mafia, terrorists, all these bad organization. But at this point, they cannot stop it. They cannot hide it. It's going to be used from US to China, Russia, Europe, everywhere. So I got a gift for you. I made a video about cryptocurrency phases, how it works, when people buy, when people sell, when they hold, how they watch the markets going up and down. So cryptocurrency is going to be very, very important all over the world. You can trust it or not, but it's going to happen. You don't have a choice, but you have to learn, you have to understand how it works because you're going to need it. Cryptocurrency is the only currency that you can use whenever you want, however you want, and nobody's gonna control what you're doing. So you have no choice. Listen, it doesn't matter which language you use. It doesn't matter where you sit, where you are. You need to study cryptocurrency and understand it. In the future, it's going to be used by almost everyone. Remember when a computer came up, everybody was scared because no one understood what it is and what it's going to do. And when a phone came up, same. When a smartphone came up, same. When internet came up, same. But all of this stuff was used already by CIA and all other organization. So it's time for everyone to learn and study cryptocurrency because it's time to use it. Your money is going to lose value and you have no choice. So it's in your interest to study cryptocurrency because like gold, keep the value. Cryptocurrencies, some of them, they help you to keep the value of your money. You want to send money? For example, today, some countries, you cannot send millions to their country officially because those country has no the money you're sending. You cannot send $200,000, for example, in Burundi. You cannot send this money in Venezuela because these countries, they don't have this money. They don't have the US dollars. But you can send cryptocurrency, you can send Bitcoin, you can send any cryptocurrency, and everybody's going to be able to cash out. How? Because you can cash out anywhere you are. You don't have to be in Burundi, you don't have to be in Congo, you don't have to be in Venezuela, you don't have to be in the US. You can cash out wherever you are. So it's in everybody's interest to study cryptocurrency. This video is going to teach you exactly how every other big money do, to study, to understand it, and to invest. Thank you. Enjoy it, and I hope it's going to help you out. Thank you very much. Watch.
Have you heard people talking about Bitcoin or other cryptocurrencies? It's a new kind of money, digital money. Think of it like cash, but it only exists on computers and the internet. Bitcoin is the most famous one, but there are thousands of others. These digital coins are exciting for many people. They are changing how we think about money and payments. Unlike the money in your bank account, which is managed by banks, crypto aims to work differently. It often works without a central company or bank in the middle, which is a pretty big idea for the world of finance. Now let's talk about something called market cycles. It might sound a bit technical, but it's quite simple. Think about the seasons in a year: summer, autumn, winter, and then spring comes around again. Markets, especially financial markets where things are bought and sold, often have similar patterns. Prices for things can go up for a while, reaching a high point, then they might come down for a period. This up and down movement happening over and over is what we call a market cycle. It's a natural rhythm in many areas where value changes, especially in newer and more dynamic markets like cryptocurrency. Cryptocurrency markets are particularly famous for these cycles, and these cycles can be very, very dramatic. Imagine being on a really big and fast roller coaster at an amusement park. There are huge climbs that get your heart racing, and then sometimes there are very steep and quick drops that take your breath away. Crypto market cycles can feel a lot like that. This is largely because crypto is still a relatively new technology. Many people are learning about it, and there's a lot of news, excitement, and sometimes uncertainty, all of which can make prices swing up and down quite sharply. So why is it important to understand these cycles? Well, knowing about these ups and downs is like having a map before you get on that roller coaster. The map doesn't stop the roller coaster from going up and down, of course, but it can show you where the big hills are, where the sharp turns might be, and what to expect along the ride. This understanding can make the whole experience feel less scary. It can help you feel more prepared. And if you are thinking about investing, it can help you make more informed decisions instead of just guessing what to do next. So, why should you spend your time learning about these crypto cycles? If you are even just a little bit interested in cryptocurrency, then understanding cycles is incredibly important. It is like learning the basic rules of a new game before you start playing. Knowing the rules helps you make smarter moves and avoid common mistakes. Crypto markets can behave in a similar way. Understanding the cycle can help you get a better sense of these price dynamics. Learning about cycles can also be a great help when it comes to managing your own emotions. Ultimately, understanding crypto cycles can help you protect the money you've worked hard for. Being prepared for the different phases the crypto market might go through is a significant advantage for any investor. In this guide, we'll explore crypto cycles together, breaking them down into simple parts. Our goal is to ensure you understand how they work, without needing a finance or tech background. We'll use plain language and clear explanations to make this information accessible to everyone, especially beginners. We will examine each phase of a typical crypto market cycle, like acts in a play. We will talk about the boom phase, when excitement grows and prices climb. Then the peak or euphoria phase, when prices reach their highest levels. After the peak, we'll delve into the bust phase, where prices may fall rapidly. Following that, the recovery phase, where the market calms and confidence returns. By the end, you'll have a clearer understanding of crypto market behavior and how to approach investing in different phases. Let's begin. The journey into a crypto boom often starts quietly, almost like a secret whispered among friends. It might begin with a brand new cryptocurrency project, something that promises to solve a big problem or offer a unique technology. Initially, only a small group of people, often those very interested in technology or finance, will notice. These are the early adopters, drawn in by the fresh ideas and the potential they see. They start discussing it in online forums, specialized chat groups, and social media platforms dedicated to new tech. This initial spark of interest then starts to spread, slowly at first, then with gathering speed. As more people learn about it, the general feeling begins to shift from simple curiosity to genuine, palpable excitement. It's about the possibility of being part of something big, something revolutionary. Sometimes the price of the crypto coin itself might start to show small, encouraging increases. Once excitement spreads, the cryptocurrency's price often sees a noticeable impact. As more individuals buy in, increasing demand pushes the price upwards. It's a simple case of supply and demand. This upward price movement can quickly catch the eye of a wider circle of people, including investors. This is when FOMO, or the fear of missing out, can begin to subtly influence decisions. The climb in prices can sometimes be surprisingly rapid, almost like a snowball rolling downhill, getting bigger and faster. This creates a positive feedback loop. Rising prices attract buyers, whose buying activity pushes prices even higher. The momentum starts to feel unstoppable. The sheer power of the upward trend can make it seem like the prices will continue to go up indefinitely. As the prices of a particular cryptocurrency, or even the crypto market as a whole, continue their impressive climb, they inevitably start to attract the attention of the mainstream media. What was once a niche topic discussed in specialized forums now begins to appear in major news outlets, financial publications, and popular websites. Journalists start writing articles about the crypto phenomenon. You might see segments on television news programs discussing the latest price surges or interviewing people who have made significant money. Social media also plays a huge role, with hashtags related to the booming crypto trending widely. The nature of this media coverage during a boom phase is often very focused on the dramatic price increases and the exciting stories of newfound wealth. Headlines might scream about Bitcoin millionaires or the next big crypto to explode. While some reports might offer balanced views, many tend to highlight the most sensational aspects because that's what grabs public attention. Stories of ordinary people making life-changing sums of money can be very compelling, and can make others wonder if they too could achieve similar results. This type of coverage significantly amplifies the general excitement and awareness surrounding cryptocurrencies. This increased media spotlight has a profound effect on the general public. People who previously had little to no knowledge or interest in cryptocurrencies start to hear about them constantly, from the news, on social media, or even from their friends and family who are getting swept up in the excitement. The constant barrage of positive news and success stories can make it seem like investing in crypto is an easy way to get rich quickly. This is when the herd mentality can truly take hold, where people start buying simply because everyone else seems to be doing it and they don't want to be left behind. This creates a powerful, self-reinforcing cycle. The rising prices attract media attention. The media attention introduces cryptocurrencies to a much wider audience. Many of these newcomers, driven by FOMO and the allure of quick profits, decide to invest, further increasing demand. This increased demand pushes prices even higher, and these new record-high prices in turn generate even more intense media coverage. This feedback loop is a key characteristic of the boom phase and explains why prices can escalate so dramatically in what can feel like a very short period of time. Why do crypto prices skyrocket so quickly during a boom? It's a mix of innovation, speculation, and psychology. Early believers are drawn by new technology or a compelling story, creating a foundation of genuine interest. But as prices rise, speculators pile in hoping to flip for quick profits, fueling even more volatility. Limited supply is key. With coins like Bitcoin, there's only so much to go around. When demand explodes, prices surge. It's basic economics: scarce assets plus hype equals soaring prices. And don't underestimate the power of crowd psychology. Euphoria and FOMO take over, pushing people to buy at any price. The optimism drowns out caution, and risk gets ignored. That's how a boom turns into a frenzy, fast. Picture reaching the summit of a mountain breathtaking, but you know you can't go higher. In crypto, a peak looks like prices going vertical and everyone talking about it everywhere. When your barber, your neighbor, and your least tech-savvy friend are all giving crypto tips, enthusiasm is maxed out, headlines scream about overnight millionaires and this time is different, caution is drowned out by hype and past crashes are dismissed. You can't time the exact top, but you can spot the signs: extreme optimism, parabolic price moves, and mainstream mania. The more people believe the party will never end, the closer you are to the edge. Recognizing these signals is more valuable than trying to sell at the very top. Stay alert when the crowd is most euphoric. At the peak, euphoria rules. Everyone feels like a genius as their portfolios soar. Logic fades, optimism and greed take over. FOMO is at its highest, and people throw caution aside, sometimes risking everything. Stories of life savings invested, loans taken out, and jobs quit become common. These aren't rational choices. They're driven by the illusion of endless profits. When everyone's convinced they'll get rich, it's usually a warning sign. The latecomers, lured by hype, often buy at the top. That's when the cycle is ready to turn. While most are swept up in euphoria, experienced investors see warning signs. They notice scams and low-quality projects attracting big money. Clear signs of indiscriminate buying. When everyone, even the uninformed, is giving investment advice, the market is saturated. Watch trading volumes. A final spike or a drop can signal a turning point. Smart money quietly sells to the crowd. The key is to stick to your plan and resist the herd. Emotional discipline is tested most at the top. Don't abandon your strategy when everyone else is losing theirs. At the market's zenith, gains seem magical. Every coin rises, no matter how absurd. Even veterans get swept up. But a quiet voice whispers, "This is too good to be true." When profits are effortless and everyone's an expert, it's a classic warning. Extreme excess is always followed by a correction. If the narrative sounds like a fairy tale, trust your gut. Latecomers, drawn by hype, buy from early sellers cashing out. Recognizing this dynamic is crucial to avoid painful losses. The higher the euphoria, the greater the risk. After the frenzy, the market can turn sharply like a party where the music suddenly cuts out. Sometimes it's triggered by bad news or a big investor cashing out, but often it's just a tipping point of collective doubt. Prices drop, and the first cracks in optimism appear. Smart money starts selling, locking in profits, while others hope it's just a dip. Anxiety replaces euphoria as red numbers appear. Social media shifts from hype to caution. Many stay in denial, calling it a healthy correction, and urging to buy the dip. But in a true bust, these dips are just the beginning of a longer slide. The belief that the bull run will resume keeps many trapped. Recognizing the shift early can save you from the worst of the downturn. If the initial price drop fails to recover quickly, prices begin to fall even further. The mood in the market can change very rapidly from cautious optimism to outright fear. That first dip starts to look more ominous as it deepens, and investors find themselves at a loss. Automatic sell orders might get triggered, adding more selling pressure to the market. The realization dawns that this could be the start of a serious crash, and the desire to minimize losses intensifies. This is when panic can truly take hold. As investors see the value of their crypto holdings decreasing rapidly, a primal instinct to escape the danger kicks in. This widespread fear fuels a desperate rush for the exits, creating a chaotic selling environment. The mechanics of a market crash are often described as an avalanche. It becomes a self-reinforcing downward spiral. When everyone is trying to sell at the same time, prices have nowhere to go but down, often very steeply. Headlines switch from stories of crypto millionaires to warnings of a crypto bloodbath or market collapse. After the panic selling subsides, the market is left in shock. The aftermath is characterized by widespread financial losses. Many see their portfolios shrink dramatically. Stories emerge of individuals losing life savings while chasing quick wealth. Excitement is replaced by regret. The party is over, and the cleanup begins. The latecomers are hit hardest, having bought at the peak, convinced prices would only climb. They experience the full force of the crash with no profit cushion. This leads to disillusionment, damaging financial confidence. People look for someone to blame: founders, influencers, or exchanges. Regulators increase scrutiny, and calls for stricter rules grow louder. Beyond financial losses, the bust leaves lasting psychological scars. Trust erodes, and many vow to never invest in crypto again. After the initial panic selling and sharp declines, the crypto market usually starts to slow down, though it may not be completely over. This phase is often characterized by exhaustion. Most panicked sellers have already left. It's common to see occasional short-lived price rallies, often called dead cat bounces. Eventually, after a prolonged decline and sideways movement, prices may reach a level where selling pressure dries up and the market may start to form a bottom. The intense media coverage disappears, and the general public loses interest. While painful, it's a necessary part of the cycle where the groundwork for the next potential recovery begins. After the bust phase, the crypto market enters a quiet period. Prices no longer fall sharply, they drift sideways with small movements. This phase has low trading volumes and less public interest. Price stabilization occurs because panicked sellers are gone. Remaining investors believe in crypto's long-term potential. There's not enough buying or selling pressure to significantly move prices. The market's psychological state shifts from euphoria and fear to disillusionment or patient waiting. Discussions focus on technology and use cases, not price predictions. This quiet period is crucial. It washes out excesses. Weak projects fail, allowing a more sustainable foundation for market recovery. During this quiet phase, smart money starts to pay close attention. Accumulation is when informed investors gradually buy an asset, like cryptocurrency. They do this when prices are low and market sentiment is negative. They're focused on long-term value, not quick flips. These investors could be institutional investors or experienced traders. They rely on analysis, research, and a long-term perspective. Accumulation is subtle. They buy quietly over time to build positions without spiking prices. They buy when others are pessimistic because they see opportunities for future growth. During the recovery phase, prices might remain flat, but important work happens behind the scenes. Cryptocurrency projects that survive often focus on development, releasing upgrades and forming partnerships. Increased adoption and tangible progress build fundamental strength. These developments subtly shift sentiment discussed in crypto communities. Each milestone acts as a building block, restoring cautious optimism. It's like seeing the first green shoots appear after a long winter. The community and developers are critical, innovating and strengthening the ecosystem. This hard work creates a solid foundation for future growth, attracting long-term interest. It is incredibly important for anyone involved in the crypto market to understand that the recovery and accumulation phase can last for a very long time. It is not uncommon for this period of sideways price movement and slow rebuilding to extend for many months or even years following a major bust. This phase requires a great deal of patience from investors. It is not about trying to make quick profits. Rather, it is about strategically positioning oneself for the next potential market cycle, if and when it arrives. Trying to rush this phase or expecting a rapid return to boom times is often a recipe for frustration and mistakes. So, what can investors consider doing during this extended period of calm? For those who maintain a long-term belief in specific cryptocurrencies, a strategy like dollar-cost averaging or DCA can be sensible. This involves investing a fixed amount of money at regular intervals, regardless of the price, which can help average out the purchase cost over time. It's also an excellent time for continued learning and deep research into projects, focusing on their fundamental value, technology, team, and adoption, rather than just short-term price movements. Sound risk management practices remain absolutely essential, meaning never investing more than one can afford to lose. One of the biggest challenges during the accumulation phase is avoiding discouragement. The slowness of the market, the lingering negativity from the previous crash, and the lack of exciting news can test the conviction of even dedicated investors. It's easy to lose interest or to start doubting one's strategy when prices seem to be going nowhere for a long time. This is precisely when having a well-thought-out long-term plan and sticking to it becomes paramount. Emotional discipline is key to navigating this phase successfully, resisting the urge to abandon a sound strategy due to boredom or temporary setbacks. Ultimately, this recovery and accumulation phase, with all its quiet rebuilding and patient positioning, sets the stage for the potential start of the next crypto cycle. The assets that are steadily accumulated by informed investors, often at lower prices, can form the base for future gains. The stronger technological and community foundations built by surviving projects can attract new interest when market sentiment eventually begins to improve. And so the cycle may begin anew, hopefully with participants who are wiser, more informed, and better prepared thanks to the lessons learned from the journey through all its distinct phases. Throughout this guide, we have journeyed together through the often wild and unpredictable landscape of cryptocurrency market cycles. We started by understanding that these cycles, with their distinct ups and downs, are a natural part of many financial markets, but they are especially pronounced in the world of crypto. We explored the boom phase, that exciting initial period where a new idea or technology sparks interest. Prices begin their upward climb, fueled by growing enthusiasm and early positive news. This is when the first wave of investors, often drawn by innovation, start to get involved, and the momentum begins to build for what's to come. Next, we looked at the dizzying heights of the peak and euphoria phase. This is where the market often reaches its highest point, and emotions like extreme optimism and greed can run rampant. We saw how mainstream media attention intensifies, and stories of quick riches draw in a much larger crowd, sometimes pushing prices to unsustainable levels. Then, inevitably, we discussed the bust phase. This is the challenging period when the market turns, prices fall sharply, and panic can set in. It's a stark reminder that what goes up very fast can also come down, and that managing risk is crucial for every single investor. Following the turbulence of the bust, we delved into the recovery and accumulation phase. This is often a much quieter, longer period where the market stabilizes and the hype dies down considerably. It's a time when patient, informed investors, sometimes called smart money, may begin to slowly accumulate assets they believe are undervalued, looking towards long-term potential. This phase is characterized by a gradual rebuilding of confidence, often driven by real technological development and a return to fundamental principles rather than by speculative frenzy. It can be a slow process, demanding patience and a clear strategy from those who remain. The core lesson from understanding these distinct phases is that crypto markets, like many other markets, are driven by patterns in human psychology. Recognizing these patterns doesn't give you a crystal ball to predict the future with perfect accuracy. No one can do that consistently. However, it does provide you with a valuable framework. This framework can help you make more informed decisions, manage your emotions more effectively, and approach investing with a greater sense of awareness and preparedness. It helps you understand the context of market movements, rather than just reacting blindly to price changes. How can you use the understanding of market cycles to invest smarter? Become a keen observer of market sentiment. Peak euphoria could be when everyone is giving crypto tips or news outlets scream about record highs. Conversely, negative news might indicate accumulation. Don't get caught up trying to perfectly time the market. Instead, focus on recognizing the broader characteristics of each phase. Develop a clear investment plan and stick to it, regardless of the market phase. Decide on your goals, risk tolerance, and strategy before you invest. Never invest more than you can comfortably afford to lose. Approach crypto investing with a curious and informed mindset. Knowledge and a calm, rational approach are your best allies in the dynamic world of crypto investing.